Hello and welcome to Zillow Rentals Q1 Quarterly Market and Renter Insights webinar. I'm your host, Brian Miller, Director of Partner Experience and Engagement for Zillow Rentals. We are so glad you could join us. At Zillow, we have entire teams of researchers dedicated to learning and exploring data around the journey people take to find their next home. That means market economic insights, renter or buyer behavior, pricing, trends in technology, and so much more. And we want to share some of what they're uncovering with you, our partners. So each quarter, we'll be bringing you new and interesting data and analysis you can use to get smarter about our industry and your business. So let's get started. Today, we're going to hear from two great speakers. First up, we'll have Zillow's Chief Economist, Skylar Olsen. No one in the business gets more excited about economic data than Skylar. And she's going to explore how some of the recent economic factors you've been seeing, like the banking crisis, might impact buyer or renter behavior in the months to come. So let's turn it over to Skylar.
Hi, my name is Skylar Olsen. I'm the Chief Economist here at Zillow, where we have a lot of great housing data, which is particularly important and valuable in a time when the world is a little bit crazy. I like to remind a lot of the people that I work with right now that the world is actually not chaos, it's just really complex. And data can help us do, the work of understanding or at least validating our experience, often for how crazy sometimes things are. We've gotten a lot of major economic news over the last couple of weeks, maybe few weeks at this point, if you're watching us. Let's dive into the overall economic environment, what we might be able to expect, how that might help rental markets. And actually, even before we go to how it'll affect rental markets, let's talk about the signals that we can look at from rental markets about how the general economy is doing. And then let's look at how rent markets are doing across the country. And of course, check out the construction market. Okay, now let's dive in. Okay, we are at no shortage of headlines these days, some of which can be worrisome, give us a lot of anxiety about, say, a potential recession coming or greater economic stress to come. Now, that said, though, we are still in this weird environment where a lot of bad economic news can end up being good economic news, depending on who you are, and maybe vice versa. Now, that said, it's hard to imagine how major bank failures across the country end up being a lot of good economic news. Now, what happened? Now, the Silicon Valley Bank failed. Now, it failed because people, or their depositors, needed access to their own funds. Now, when you think of who the depositors were in that sense, you're thinking a lot of companies, startups that are trying to make their payroll. Why do they need to go and harvest more and more of their deposits? Well, venture capital funding has really dried up with just the larger economic risk in general. Higher interest rates as the Fed tackles inflation also makes it hard for companies to access more money through debt. So they start pulling down their savings. They pulled down their savings a lot faster than Silicon Valley Bank thought they would, holding more long-term securities, and this was true of apparently many financial institutions, than allowed those financial institutions to give the liquid deposits to their depositors. And you end up having situations where the bank doesn't have enough money. Their depositors got scared, caused what's called a bank run, and that has now caused about 3 weeks worth of headlines as we discover just how deep and just how wide this goes. Okay, now what does it actually mean? All right, now, widespread bank failure, that truly is cause for concern. How come the headlines aren't worse, right? And that's because the Federal Reserve stepped in. We do have actually mechanisms in place to handle major financial crises. I guess that's a bit of the silver lining to having gone through the global financial crisis a couple of decades ago. So what are some of those backstops? Well, the Federal Reserve, even during the initial crisis of the pandemic, made sure that banks, all sorts of financial institutions, would be able to access money, right, to cover debts, if not actually grow again out of the pandemic. Now, this graph that you see in front of you right here in the blue line, these are the total assets held by the Fed. You can see the extraordinary intervention that was made during the pandemic. Okay, it continued on and ramped up. Now, when you remember or think about the interest rate cycle of, higher and higher mortgage rates suddenly, and mortgage rates suddenly increase, or all sorts of other interest rates to access debt, build companies, become a new small business, things like that. That major reversal was when the Fed started unwinding these balance sheets and putting upward pressure on interest rates because inflation had actually kicked up too hot. And we'll look at that in a second. Now, layered on top of this, this intervention right now, today, in order to intervene and make sure banks have access to funds in order to keep those funds flowing to their depositors so that depositors can make payroll or depositors can cover their operating expenses or their bills, right? In order to do that was another major influx of cash. You see that in the little blue uptick right at the bottom. Now, okay, great. Massive intervention, major intervention by the federal government, backstopping the situation that we are currently in, right? So supporting financial markets. So financial markets aren't liquidating, but they are experiencing heightened stress, okay? This is that inverted yield curve that people talk about. Rather, this is the yield curve, and it's inverted when it drops down below zero, right? That horizontal dotted line right there. Now, why do we worry about that? When it drops below zero, the way that you want to interpret this curve, right? This is the difference between a 10-year rate of US Treasury bills, right? Or bonds, and a 2-year rate of US Treasury securities, right? Now, one of the ways that you interpret interest rates, if they're high, it often reflects higher risk. So if I subtract the 10-year from the 2-year, what I'm basically talking about is the difference in risk, right, between these two time horizons. So why does an inverted yield curve signal a coming recession? If I have a negative sign, what that means is that risk associated with the next 2 years is higher than that, letting you hold my money for a whole 10. Normally, I would expect to accept a premium if I'm going to let you hold my money for 10 years. But here we're seeing higher risk associated with the next two. An inverted yield curve then is the intuitive signal that the market expects a recession. Now, the size of this inversion is huge. It's bigger than we've seen in many, many decades. It's on scale or on par with the size of the interventions from the Fed. Not necessarily a sign of, say, all that much, again, extreme recession risk, but all that much intervention from monetary policy. So the yield curve being inverted is a sign that financial markets are much more stressed than normal. There is a lot going on right now, and there's a lot of uncertainty. Recession is certainly on the table, even more so now that we have extra stress happening in these financial markets from a bank crisis. Okay. Now, the reason why I wanted to show, the Fed and all their holdings and this intervention from the most recent crisis is that it layers on top of the experience that we've had from the pandemic in the first place. Now, whenever we experience a major economic shock, think of it that way, as like a shock wave. You look at these graphs in front of you. These are some of the graphs that a lot of analysts that are thinking about the world these days, joke that we broke the y-axis, because we have so much extraordinary change so quickly. On the left, here we're looking at labor tightness. So the difference between the number of unemployed and job openings. During the initial crisis of the pandemic, we had a lot of people out of work, right? Because we were shut down. Then as time went on, now we're, a few years on now, right? Into the pandemic, at least certainly more than 2, approaching, 3 years now on into this crisis. And you have the aftermath of the Fed's intervention in the first place, that massive influx of liquidity to support markets. You also had that fiscal stimulus, right? That caused many, many, many more job openings, almost twice as many than there were unemployed, active and willing, to take them. Now, that, this now on the right side is looking at U.S. employment growth, right, at this time. As you can tell, look at that black line, that it remained fairly steady. So in other words, I had this pretty good divide, this pressure on labor, and yet our job growth was still continuing forward. Now, this is during a time when the Fed was trying to put downward or upward pressure on interest rates to crack down on this kind of pressure. This is a signal of an overheating economy. Too many job openings for unemployed, willing and able to take them, putting pressure on wages, putting pressure on prices. Now, I wanted to show you this graph in particular because I want to show that information side. So in orange on the right side, this is information employment. Think about this as kind of capturing the tech industry. Not quite, it's not quite indicative of the full thing, but this is the headline maker of what we were originally worried about when thinking about what happened if, say, Silicon Valley's depositors couldn't access payroll, right? What would happen to this industry? We were worried about a tech-focused recession. These days, we're worried about a recession that's a little bit more general, but this set of employment, so think places like San Francisco, Austin, Seattle, Denver, and various other markets that have become more and more tech concentrated over time, tend to be slowing much more than markets in general, right? This is actually, I looked at a lot of industries. This is one of the few industries that are actually seeing employment lowering at this time, okay? So it depends very much so what happens next, right? Let's say we go into a recession, who experiences the job loss? Okay, now what you're seeing in front of you here is employment over time. We are absolutely worried about a recession. The painful part of recession, how it impacts housing markets, ends up being our willingness to move because we feel flush and confident that we'll keep the job that we currently have, right? Or we're going to move to a new job, even better paying, right? So I want this good, consistent job growth. Now, I want pay attention to that black line. Notice job growth in general, growing, steadily out of the pandemic. We're currently around 2% higher than what we were when we started the pandemic in the first place. I've matched all the industries together at the same point in February 2020, so we can see how they've moved differently. Now, the job growth that we're experiencing today that continues to heat up the economy, continues to drive inflation. Notice that that's an accommodation and food service. That's, actually really great job growth for some of them are entry-level multifamily housing units, right? This is great job growth for much more, concentrated places, much more, urban areas, greater density, right? Where the multifamily units often are. This kind of job growth signals, again, returning, maybe we're not quite back. Anyone who's gone to a lot of the downtowns, it obviously matters from metro to metro, but certainly often not back to total normal. Of course, with this industry, as we see, we're still almost 2% below where we were pre-pandemic, but this is consistent job growth, returning vitality to a lot of those places. Now you can see information. There's the one where the job growth happens. In other areas like finance and other higher earning fields, this is too where things are moving much more slowly. So say we move into a recession, it should or could be felt much more heavily. Higher earning fields felt more heavily on more luxury units, say, right, on higher end properties. Say single family markets might feel more of a slowdown than, say, middle tier, more affordable units, right, in terms of what we expect moving forward and where it hits. Because this accommodation of food service growth could absolutely slow down during the recession, but is still also a bit more about this initial shock. Right? This, again, is adding to this level of uncertainty. How bad will the recession be? What industries or income groups? In other words, and when I say industries, that ends up being like what metros will be impacted. We're now in a space where things are much more uncertain, and it comes down to the industry or locality in terms of where the distress is. Honestly, that's a good sign. It means we're not going through a really hard overarching, recession, or we wouldn't expect one still to be that extreme on a national level, but certain individual markets could feel it more. Okay. Now, against this backdrop, backdrop, this is where the uncertainty comes in again. We're very interested to see whether or not the pressure on prices will actually come off. If anyone's been following the Federal Reserve news cycle, you know what's happening with their policy putting pressure on interest rates. But despite the bank failure, well, because of their intervention as well, so bank failure plus their big intervention to provide liquidity to the banks, they decided to still put upward pressure on interest rates, just 25 basis points, but it has everything to do with this graph. So what are we looking at here? Here are some of my favorite ways of measuring core inflation. Now, when you think of federal policy, the core part matters. Now, you at home, when you're thinking about your budget, core is not the full picture, because what people usually take out in core is food and energy, which are a big part of how we live and move about a metro, of course, but they're highly volatile, so hard to predict. So here we're graphing measures of core. If you're looking at something that says PCE, that allows us to substitute away from price spikes, right? So say the price of chicken is really expensive and I can consume pork, I can avoid that price spike. So you see those are generally lower on the left, see that year over year on the left, than say the purple, which is built from the consumer price index, and that's a really fixed basket. So you can't substitute away. You see there that that also tends to be higher. By the way, for the CPI, add food and energy back in. Record headlines were set to say, year over year, over 9%. Not a lot of us got a raise, over 9%. So it's very hard to continue to afford that fixed basket today, and people are feeling that in their budgets. Okay, but I want to talk about what's coming next, because that's what is going to affect Fed policy, and then Fed policy is going to affect interest rates. Interest rates matter for housing, of course, because of home buyers' access to monthly affordability and get qualifying to enter the for sale market. So if interest rates are high, that's a headwind for rental markets, right? Because it keeps households from being able to move into for sale, so they rent for longer. But we still need access, to funds in order to develop capital projects like apartment buildings. So higher interest rates also impact our new construction side of the multifamily picture. Okay, so interest rates still matter a lot. So what's happening next? It still depends everything on whether or not this number comes down. Hopefully inflation numbers come down with a lot of the new, recession risk and companies making a lot of decisions to slow down in response to it. But before that, the pressure was back on. And we see that here on the right side, looking at month over month annualized. This is the way of saying, if this rate of pace in this month continued all year long, right, how high would say that year over year be? So we can compare the left and the right. But notice it's much more volatile. It is hard to predict. You might have noticed a news cycle of people congratulating themselves that inflation was coming down, and the most recent numbers were absolutely a big upset. Very interesting what will happen next. But this adds again to our picture of uncertainty. I have a news cycle about bank failures and recession risk. How wide is that financial market uncertainty, right? And what will that impact be? That is layered on top of a market that was pre-existing overheating. Inflation was still a very huge challenge. How these match each other to move forward is certainly part of the uncertainty to come ahead. Okay, so it all comes down to inflation coming down. What can I turn to besides looking at the pressure in the employment market, which we just looked at, right? Labor market tightness. Where else can I look for either confidence or a signal, something to show me that inflation good and truly is coming down? Well, turns out shelter is about a third of those fixed baskets. And of course, it's a major part of how we as consumers spend our money. So here I'm looking at the two kind of housing components of CPI, one, the owner's equivalent, and another, renting your primary residence. You see these over time. Again, I'm looking at the month over month annualized because it gets me out to the current pace, right, of things that helps me predict how things are moving into the future. You can see the CPI of the residential component is still elevated, right? The current pace is just under 10%. You're looking around 9.5% for rent of primary residence and a little bit slower for owners occupied, right? So a little bit smaller pressure, I guess, on single family markets. Now, if I compare those graphs, I want you to think about it though. With CPI, the rental component, there I'm capturing releases across the full stock. That is a slower thing to move. How do I know? Well, look at Zori, Zillow's Observed Rental Index. Let's spend a little time thinking about this one, and I'll show you what it looks like, not just the month-over-month annuals in a second. But Zillow's Observed Rent Index is kind of an exciting measure. I really like it. What it does is it tracks the listed rent, so asking rent on a unit that we see listed on Zillow at least twice. So we can observe the change in rent on a given unit to control for the mix of homes over time. Here, then, we're tracking market rate leading asking rent. That then filters down through releases, right? Going from market rate new leases to renewals, right? Over time on what? We have customers that generally on average sign annual leasing terms, right? So it takes that long to filter through. Now, in July 2021, we hit our largest month-over-month annualized pace. That, if I annualize it out, that month-over-month pace is almost 30% growth in rent annually. By the way, our record month-over-month or year-over-year is much lower than that. We'll see that in a second, but this is annualizing that month-over-month pace. But things started to slow down after mid-2021. Now, that is also when we saw the release component at least stop growing. So here we're thinking that we're leading, the Zori leads the shelter component of those inflation numbers by about 12 months. Knock on wood, right? This is a signal that we should maybe hopefully start to see those shelter components of the inflation numbers come down in months to come, just like we saw Zori, come much lower than certainly last year's rental market price pressure, but even a little bit softer than pre-pandemic. We'll see that in a second. Now, that's great. That gives me renewed confidence that we are doing some work when it comes to inflation to slow down at least that big ticket item, right? And hopefully that's a sign that the Fed, again, will stop having to put upward pressure on interest rates. And that gets us a lot back into a normal environment moving forward. Okay, so it still comes back down to inflation for a lot of people's expectations for what happens in the general economy. We have to get inflation down. And the reason why that is because it's really painful. So I know you might have seen headlines about people saving records amount of money during the course of the pandemic because we weren't vacationing and we're not eating out, we're changing the way that we're living and we're holed up in our homes. That's no longer true. And if anything, inflation above and beyond people's incomes and their income growth, even when wages have also grown much faster. You see that on the left here. ECI, as private industry wages, have sort of not really kept up with inflation, but better than you might have thought. But yet savings rates are now far, far, far below where they are normally pre-pandemic, right? So we're entering a time where people are, in other words, really pulling down out of their savings. They might have built up a lot of savings at this time, but now they're working it all the way down right here. And that is lending to less confidence to pick up and move, and change your life and move forward. And that's pulling pressure off of the economy in general, rental markets included. Okay. We spent a long time talking in general about what happens, in the general economy. We did mention a little bit how it'll impact, rental markets, and we'll get even deeper in the future. But I want to double tap on this idea about how mortgage rates are important to rental markets too. Now, I mentioned earlier that mortgage rates, when they're high, are actually a tailwind for the residential market because households can't easily move on into the for sale market. Now, until we get out of this world of uncertainty and past financial market distress, mortgage rates are going to continue to bounce around at relatively high levels. You see this picture in front of you. Absolutely, our mortgage rates high, but let's think about what that means for the for sale market and for the ability of, say, the average median household income earner to qualify and move forward within the for sale market and get a mortgage. The left-hand side of this graph is homeowner affordability or a homeowner housing burden, right? So what would you expect the mortgage payment, property taxes, and insurance to take out of the typical household income? You can see that this thing changes a lot with interest rates. I've actually, in this graph, I've fixed home values and I've fixed incomes, and I do also fix then your property taxes and your insurance. And you can see this bounce around like crazy around that affordability rule of thumb that we often talk about. Don't spend more than a third of your income on housing. Now, we know that lots of people go beyond spending a third of their income. That graph on the right shows you that the median household income, or rather the affordability of a typical unit in an area to the median household income in that area ranges a lot. In a place like, say, Los Angeles, even before, say, the most recent uptick in interest rates, right? The median household income, you would need over 60% of it on a mortgage payment, property taxes, and insurance in Los Angeles. After the mortgage rate increase, you're looking at 80%. Now, in so many ways, that means that the median household does not buy a home in Los Angeles. That's why you have so much higher rentership rates. And as this continues to be true for more and more areas, rentership might truly increase. A larger share of households at all age groups would be renting if you cannot move forward into the for sale market. Now, there's a bit more that stops people from moving forward. Some of it is just that it's up and down and up and down and up and down, right? That's an experience like qualify, don't qualify, qualify, don't qualify. But at elevated mortgage rates, in fact, while mortgage rates remain, if you can see my cursor here, while mortgage rates remain above 5%, for sale, new homeowner affordability will remain around this rule of thumb, about as bad as we got during the last housing bubble bust, and provide a big barrier to people moving forward. Okay, so here's the tailwind to the rental market from people's inability to move ahead. This graph takes that past one that we just looked at. You see, this is now that gold one. You see that up, down. But I want to now change home values over time as well and incomes. And I'm adding in this picture into the rent burden to really drive home what I mean by a tailwind. After mortgage rates went above 5%, homeowner burden at the typical median household income for the typical housing unit, right? The rental burden is much lower. In other words, for the typical unit across the US, if I'm looking at a monthly affordability basis, renting right now looks a lot better. Now, this is not the full picture of this economic decision, right? If you're renting, you should also be investing your money somewhere else, right? In order to beat inflation. When you buy a home, that money is also appreciating as home equity. So it's not just about the monthly payment, but this is a huge influence on people's decision making. This is one of the reasons why home prices are now moving so slowly, because they continue persisting in rental markets instead. Qualify, don't qualify, qualify, don't qualify, or my alternatives are just better in the first place. Now, that will depend a lot on where I live, and we can see that later in more data. Now, the other challenge to moving forward into for sale markets, and this is actually going to be key when we think about what's going to happen next, right, is that the options that someone has when they go to that for sale market are fewer and fewer than there used to be. Now, you see this graph ahead of you, that pale bar in the background, that's what used to be typical during a home shopping season for any of the given months in terms of the number of homes that would be newly listed from homeowners. Now, you can see when I compare, those dark bars, so 2022, last year, we had fewer new listings than we had, say, pre-pandemic, because during that time, we were absolutely already experiencing interest rate lock-in. In other words, who's more sensitive to the fact that interest rates are at 6%, 6.5%, and jumping around? The homeowner's holding on to 3%. A current homeowner wants to keep that affordability, is holding on to more and more units right? And we see in 2023, the rate of new listings coming onto the market is far below what it was pre-pandemic. Interest rates came back up. We're bopping around 6.5%. Homeowners' interest rate lock-in is absolutely renewed. Okay, so it's harder and harder for households to enter for sale markets, whether from affordability reasons or because the inventory is really just not there and coming online. What that ultimately does is we were reporting that home values were falling due to the affordability challenge. But as new listings remain so low and as existing for sale inventory remains so low, the pressure on home values has been a bit maintained. You can see this in those month over months that has returned back up to zero as opposed to falling with more negative numbers. Okay. So the year over years in the for sale market will continue to come down, but those months over months, they're stabilizing. Why am I spending so much time on the home value market? It's because when we think about it, I can't then promise in the for sale market this idea of home values crashing and renewed affordability for the first-time home buyer. In other words, because both supply and demand is responding within the for sale market, suppliers pull back, prices are maintained, this might end up being a tailwind, or rather poor affordability in the for sale market will be a tailwind in the rental market for time to come. Now, a lot of this is up in the air still. If we experience a very deep recession with significant job loss, particularly in higher earning households that tend to be buyers, or at least the marginal buyers on the cusp of moving forward, then we might see home values start to come down again, right? And that tailwind on rental markets may ease. But until that happens, I don't think we can promise someone a big drop in home prices despite high mortgage rates. It's more that for sale markets are just frozen. So moving forward, what's happening in the rental market? This is Zillow's Observe Rent Index in that blackish, I think it's actually technically really dark maybe, but in that blackish line there, you can see we're up to a typical rent across the US at around $2,000. That is up 33% from pre-pandemic. You can see the complete stall for the first year of the pandemic, right? Eviction moratoriums, everyone is just locked down, really just frozen markets across the board. But in that second year, we saw really, really significant rent growth. Some of that is, of course, reopening. Some of it is making up for lost expenses, right? And some of that lost pressure. Some of it is stimulus payments, right? And a lot of other things flowing into the market and putting pressure on all sorts of prices. But here you see we maxed out at over year over year in rental markets during this, pandemic recovery period at around 17% year over year. That is pretty wild. Rent has since come down, slowed down. Our year over year is now only 6.3% nationally, but let's pay attention to those month over month numbers. Now, that most recent data that we have, that's our February number. Month over month growth is around a third of a percentage point. Look back in time on those month over month hills, you can see it's a very seasonal pressure, right? More pressure as people start moving. And we enter the spring and summer months, right? The pressure eases as we go back into the late winter months. But we can see here, I've marked every single previous February. So compare 0.3 to what I've seen historically, and I'm a little bit on par, but a little bit softer with pre-pandemic rent pressure. Now, we had been slowing down more in rent growth as well, I think, along with a lot of the same news cycle that we had been experiencing. Just higher interest rates making it harder for people to grow and keep hiring, right? And stabilizing the economy just in general, right? Now, that slowdown in rent, though, has eased and rent has come back to stabilize a little bit closer to pre-pandemic. Now, I think in one sense, this is a good thing, right? It is a sense of having a lot of strength in our underlying economy in a lot of these markets across the US. But just like these days where good news can also be bad news, remember earlier when I argued that I really wanted to see the shelter component of inflation to come down to give myself confidence that overarching inflation, may also be impacted, and we might see less of a news cycle around, pressure on interest rates and, more, in other words, recession risk, right? These days moving forward, this is good news. Then on the flip side, again, remember, in terms of how it can impact inflation is potential bad news. Just knock on wood for now and say that there's still a lot of these headwinds in the rental market. There is still a lot of fundamental demand. Accommodation food service continuing to reopen. These are all good signs moving forward that even if we do see a recession, it'll be an odd one, right? That still has a lot of energy and different components. Okay, now we are slowing down, we are slowing down certainly from last year. We're renewing, stabilizing that rent growth to be a little bit softer nationally than pre-pandemic. That's true in a lot of major different metropolitan areas. I'm showing you here the zip code level data that we have on our Zillow Observed Rent Index. So you can see across the Seattle major metropolitan area. So that's a 3-county group. And then you can see the month-over-month change and year-over-year. Now, what I want to point out is that year over year, we saw and we can still see some of this systematic pattern in terms of how far out and where that pressure was, right, across space. Now, I want to focus on the month over month, however, and point out that I can't really find as much of a pattern. It looks much more like a patchwork. That's because as rental markets start to stabilize, right, some regions are going to experience, some local areas are going to experience very, very different pressure from others. So local data is perhaps even more informative now than otherwise. Please reach out and get, to your contact. We can absolutely share a bunch of zip code level rent pressure data that you see mapped here in major metropolitan areas across the country. Now, if I was to show you that month over month graph, over the course of the early pandemic, you would have been able to see rent really, really soft, if not falling a lot in those urban cores. And you'll see that ex-urban ring with that pressure. Just today, that pattern is lost, right? It's now much more of a patchwork, much less systematic storytelling. Why? It comes down a lot to the supply and where it's coming on. Now, I probably should have switched it around, but here's that pressure on the metro level, right? You can see again, it's also a much more local picture. So what's same at the zip code, true across metropolitan areas in the US. Here you can see many metropolitan areas with rent declines at this time, where usually we expect to see a little bit of positive pressure. Other major metropolitan areas, you see that pressure still maintained, in some cases much higher than it was pre-pandemic. Some of it is, again, just where we are in this cycle of that economic shock. A lot of it comes down to how many units have been produced and where they have been placed. And then again, that first, what we started talking about is where is the job loss, the economic environment around the local industries the most uncertain, right, moving forward to impact. Okay, so individual stories all across the country, individual stories all across the metro. Across the board, though, and I really want to drive this last point home, because it does tend to be one of our tailwinds on rental markets, is that rent growth over the course of 2021 and early into 2022 was very extreme, much faster than incomes. This is looking at the change in rent growth since the beginning of the pandemic. So here we're looking at 3 years, right? From 2020 to 2023. So this rent growth was experienced to various degrees across the country. Check out Florida. That's really wild. Remember, I joked earlier, in some ways the joke is we've broken the y-axis. Some of this growth is really incredible. We saw a lot of relocation down the eastern seaboard that absolutely benefited Florida. Similar on the western seaboard, right? As you move down into Arizona and Southern California markets, that's where you see the rent growth had been a lot. A lot of that is pandemic migration related. We'll see that pressure move off in many ways, in some places more than others. Some people call things price corrections. I like to call them clapbacks at this point. But you'll see that to various degrees depending on how big your original shock was. Now, why does that matter? I did talk about how the for sale market has challenges to their to the new home owner affordability because of higher mortgage rates. Rental markets on average, nationally speaking, are now more affordable than for sale markets on a monthly basis because of those mortgage rates. But that does not mean they're affordable as a whole or even relative to last year because of those price increases. Here you see how much that differs over the major metropolitan areas across the US. Again, I'm matching typical rents to a median household income. You can see that affordability challenge is the worst in those same places where we saw rent growth be so extreme over the course of the pandemic is where we see the most challenge today. Now, that affordability problem, I'm an economist, so when we talk about what do you do about it or how do we solve this picture, it always comes back to the picture of supply and demand. We just talked a lot about demand. Let's get to the supply picture. We still need so many housing units. Now, in the single family market, there is much less pressure today than there was, say, even pre-pandemic. And that has everything to do with the mortgage rates that we've talked about. It has everything to do with a boom in single family units over the course of the pandemic. Look on that left side, though. Here's where we're looking at single family units. Look at units started, put it into context. The units started in the single family market were still nothing compared to what happened during the previous housing bubble. So this is not a single family boomer bubble. We have a bit of a reaction where we're building we're starting fewer units, single family units now than we were pre-pandemic, but that has begun to stabilize. So has the number of units under construction in that market. That's a different story if I look at multifamily, right? This is most certainly a multifamily building boom, both in terms of the number of units that are still under construction, not quite yet stabilizing, and then even units started have stabilized, but at a level above pre-pandemic and certainly above where they've been for decades. Now, a lot of that, I think, is a recognition of what I've already talked about, where the barriers to the for sale market might not resolve themselves very quickly. Prices might not fall very much because new listings pull back, right? Mortgage rates, we were optimistic that they'd come down, but we're back to being pessimistic that they'll continue to jump around, and it's really uncertain out there, okay? So there's a lot of still, I think, is it faith or trust, confidence in multifamily units and their performance into the future? That's made units remain elevated. That's a bit of a different story. Certainly still for single family units. Now we're looking a bit more up the pipeline, not just units started, but permits. Permits are even more pessimistic in the single family market than we saw the starts be, though I do want to acknowledge that I think a lot of folks that think about rental markets and we think about this set, it's hard to know how many of these are built for rent. There's not a lot of great data out there, or it doesn't get updated as frequently. So when we think about what single family units are probably maintaining their build, I would expect it to be within those sectors. Multifamily permits, again, as I noted, more confident, right? Maintain this higher than pre-pandemic pace, though not as high as last year. And that has everything to do with, yes, the headwinds in the for sale market that end up being tailwinds in the rental market. But I always like to end on this slide, which really puts into perspective, I think, the relative size of now fundamental housing demand. When we go through economic cycles like we are going through, or we will be going through, that has a lot to do with all the things, right? Policy, recessions, job loss, interest rates, right? Those are cycles. In housing, we have this long run cycle as well. this fundamental demand about how many people are in prime employment, moving ages relative to previous periods, right? And what we built up for. Now, that is a particular challenge in housing because right now we have the most 25 to 45-year-olds than we will have next year. In other words, those peaking millennials, or that massive millennial generation is peaking now. And those are prime working age, prime moving milestone ages, right? Median age of a first-time home buyer is now 36, no longer 32. You are renting for a longer period of your life. That's the difference between renting, before you have kids and renting still when they're small. Right? This is a massive generation that continues to age, and boomers are not yet ready to leave their homes. Okay. So we have fundamental pressure on housing that causes a lot of affordability challenges. Over the long run, we still need to continue building in order to offer social mobility and greater affordability in our housing units to come. But a lot of that is going to depend on our ability to build more flexibly, right? And in the areas where people are moving. Thank you so much for listening to a lot of economics, a little bit of data jazz, and hopefully you gain some insight that'll help you make decisions in the world that you're in and the world that'll potentially come. Please know that at any time, if you want to look at zip code level rent trends, you can find our Zillow Observed Rent Index on our website, zillow.com/data. And we will continue to post a lot of information about the economy, both the general macro environment and housing markets, both for sale, renter, and what we're building on zillow.com/research. Take care and good luck out there.
Thanks, Skylar. Next, we're going to talk specifically about renter behavior with senior population scientist Manny Garcia. Manny and his team lead the enormous effort behind Zillow's annual Consumer Housing Trends Report, which includes surveying thousands of renters about how they're searching, what they're looking for, and so much more. Last week, Manny shared some of the most interesting data to come out of last year's report and how you might use that information to attract or keep more renters. So let's get ready to learn with Manny.
Hi, my name is Manny Garcia. I'm a population scientist here at Zillow, and I'll be your guide through this portion of today's webinar, what renters consider essential and what keeps them around. So the Zillow population science team is all about understanding the needs and motivations of today's real estate consumers. In this case, that's renters. And I'm excited to share some of our research with you today. Specifically, I'll be sharing some key findings from our 2022 Zillow Rentals Consumer Housing Trends Report, which we published late last year. This report provides a snapshot of rental customer behavior and preferences across several important categories. And today, we'll be diving into data and insights about how renters are searching for their next home, including the types of tools they're using or would ideally use through each stage of their renter journey. We'll also explore some of the features that renters consider essential and what makes them stay at a rental they love. We hope that these findings will help uncover any potential gaps between what renters want and what you're offering today, and maybe highlight some opportunities for you and your teams to address unmet renter or tenant needs. So before we dive in, let's talk a little bit about the methodology behind the report, how we collect data and what gets represented. For this year's report, our team conducted a nationally representative survey of more than 8,000 US renters. We defined renters as household decision makers ages 18 and up who rent their primary residence. The study was fielded between March and August of 2022. And whenever possible, we included survey questions from previous years, which allows us to measure year-over-year trends in some key categories. First, how renters are searching. When we ask renters how they've searched for their next home, they overwhelmingly say that they're using their mobile devices. We've seen a consistent 74% in the last 2 years, which was a jump from only 65% in 2020. We're also seeing a slight decrease in the number of renters searching on their laptop or desktop, suggesting that mobile only may be the preference for a growing number of potential renters. And we also see that they're using fewer resources when they search. Back in 2022, nearly a quarter of renters were using 10 or more different apps or websites to search for their next rental. In 2022, that number dropped to only 16%. The largest number, 39%, are now only using somewhere between 1 and 4 sources. So we're seeing an indication that renters are perhaps feeling more comfortable with the resources they are using and believe that those are representative of all available properties, rather than needing to hunt all over the internet for various listings. We're also continuing to see a consistent decline in the average number of in-person tours. As we look across the bottom row here, we see that in 2022, almost 1 in 4 renters reported that they didn't take a single in-person tour during their most recent rental search. 71% toured somewhere between 1 and 4 properties, and only 6% reported touring 5 or more homes. That's down 10 points from last year. As you can see from this chart, over time, from 2018 to 2021, we're seeing the average renters touring fewer and fewer homes, with increases in the no tour and decreases in the 5 or more. So what does this mean? We think it may mean that renters are increasingly relying on digital tools to refine their search. They're using all of the online details available in your listings. These are floor plans, 3D tours, virtual tours, and photos, and finalizing their lists well before they visit your property. So they have to take fewer tours to find the right fit. So now let's take a look at another renter activity, leasing. This year's report saw an increase in renters' use of digital leasing tools. Again, if we look across the bottom row, we see that 36% of renters report signing their lease online. That's a 6-point increase from 2020 and a 13-point jump from 2018. However, we're also seeing an increase in renter preference to sign their lease online. Just over half of renters surveyed said they would prefer to sign electronically, yet only 36% actually did. This is an example of what we call a digital divide that exists for many renters. There's a gap between the digital access renters want and what they're being offered. In this chart, we see the yellow line following a trend of the percentage of renters who are currently signing leases online. It increases over time from 21% in 2018 to 36% in 2022. The blue line above it shows the percentage of renters who want or would ideally sign their lease online. We can see there's a distinct gap between the two. And this gap indicates a potential opportunity for you and your property. Offering a digital leasing option could remove a barrier for your current or prospective tenants and add a desirable element of convenience to the rental experience, including for your own staff. We also see this digital divide when it comes to paying rent. Over the last 3 years, we've seen consistent increases in the share of renters that are paying rent online. In 2018, just 36% of renters said they typically paid their rent electronically. And in 2022, this jumped to 56%, up 20 points. Again, still seeing that digital divide between the bars here. More and more renters, 68% when we last asked in the spring and summer of 2022, would ideally pay rent online. And still, only a little over half are currently consistently doing so. So let's talk about what else renters want. The first thing, pets. In 2022, we saw continued growth in pet ownership. 59% of renters reported having at least one pet, up nearly 30 points since 2018. The most common pet was a dog for 38% of renters. We also know that of renters who choose not to move, those with dogs were more likely to report having a private fenced yard. About a third of dog-owning tenured renters said that their rental included one, versus only 22% of those without dogs. We also heard about the rising importance of price. With inflation rising and rent costs growing, 80% of renters in 2022 said they considered staying within their initial budget as a very or extremely important component of their search. That's higher than any other characteristic we asked about, including the number of bedrooms, bathrooms, having their preferred floor plan or layout, and all sorts of other shared amenities. And when it comes to whether or not they'll stay after their lease ends, renters also rated cost as among their top factors. Almost 7 in 10 tenured renters said that they had a good deal as a reason for staying in place at their current rental. And over 60% said they couldn't afford to move somewhere else. We continue to see a decline in the rating of common amenities like gyms or rooftop decks at only 23%. But many renters don't have long-term plans to stay. 64% of renters told us they're considering moving in the next 3 years, and nearly half said they plan to move in the next year. Of those, 45% said they plan to buy their next home rather than renting again. and only 10% said they had signed a lease that lasts longer than 2 years. So what can we learn from all this? And how can you apply this to lessons that are attracting more renters? First, we learned a little more about how renters are searching. We know that they're searching online and they primarily use mobile devices. We know that they're relying on fewer and fewer online sources, and we know that they're using all of the details they find to take fewer in-person tours. So ask yourself, is your site optimized for mobile? Are you listing your property where renters in your area are searching? And are you showing complete listings by using all of the possible tools at your disposal, like photos, 3D tours, floor plans, and neighborhood details, and being super upfront about your unit and costs? Properties can also stand out by helping bridge the digital divide with renters. Can you meet renters where they are by offering online applications, leases, and payments? And we know that more and more renters have pets. What can your property be doing to attract pet owners and provide accommodations that are pet friendly, like fenced in areas or dog runs? And last, we heard that budget is by far the most important factor to renters. It's the top thing they look for during their search, and it's the number one reason why they choose to stay. But we also saw that most renters are still always looking ahead towards their next move, and that might even include buying a home. So properties should carefully consider their pricing, their value, and potential incentives they could provide to a loyal renter. That's it for me on Renter Insights. As I've mentioned, this is a sampling of the data you'll find in this year's Zillow Consumer Housing Trends Report. If you'd like to find more analysis from my Zillow Population Science team or any of the research teams here at Zillow, please visit us at zillow.com/research.
Awesome. Thanks, Manny. We hope you found both of those presentations valuable and feel a little more informed about the state of the rentals market. Remember, each quarter we'll be taking new dives into unique content, like drilling down into specific metro markets around the country or serving up new renter survey data. We hope you'll join us again. And as both of our speakers mentioned, you can always find Zillow data available on our website at zillow.com/research or zillow.com/data. Thanks for being here. See you next time.